We're jumping straight into Strive today. Everyone is watching the price action, but the real story is the Bitcoin treasury strategy.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
But before we really start unpacking the nuts and bolts of this, because frankly, the financial engineering here is just as wild as the chart. Make sure you subscribe and hit the like button. We're breaking down the stories that actually move the needle for you, and you definitely don't want to miss what's coming next.
Yeah, wild is... It's probably the right word. I mean, if you look at Strive over the last 12 months, it's really not for the faint of heart.
That's putting it mildly.
Yeah.
We're talking about a stock that was literally trading around 36 cents. Fast forward to 2025, and it's hitting double digits, swinging up over $10.
Right.
That's the kind of volatility that usually screams meme stock or some kind of pump and dump scheme to a lot of people. But when you actually pop the hood here, there is a fundamental transformation happening. They aren't just riding a crypto momentum wave. They are completely re-architecting their balance sheet.
That's the key distinction right there. This isn't just retail enthusiasm pushing a ticker up. This is a very deliberate corporate pivot. Strive is essentially positioning itself as the first publicly traded asset management company with a dedicated Bitcoin treasury.
Right, and obviously the immediate comparison everyone jumps to is MicroStrategy. That's like, oh, they're the MicroStrategy of asset management. But I feel like that comparison, while it's a helpful shorthand, it misses some of the real complexity of what Strive is actually trying to pull off here.
It absolutely does, because MicroStrategy is effectively a software company that became a massive Bitcoin holding company. Strive, on the other hand, is trying to build a true hybrid model. And that's what makes the execution risk so high, but also the potential rewards so massive. You have three distinct pillars at play here. You have the Bitcoin treasury, obviously. Then you have the core asset management business, the ETFs. And then you have this totally new acquisition, Semler Scientific, which brings a medical technology component into the mix.
Which we definitely need to get into because on paper, an asset manager buying a heart monitor company sounds like an absolute fever dream.
It really does.
But before we get to the medical tech side of things, let's just look at the moat, the Bitcoin. Let's start with the bull case.
Yeah, the Bitcoin is the foundation of the whole bull case. As of late 2025, Strive holds 7,525 Bitcoin.
Which puts the valuation of just their crypto holdings at over $660 million.
Correct. And that number is critical for you to understand as an investor because it creates a theoretical floor for the company's valuation. When you buy a share of Strive, you are implicitly buying a fraction of that massive Bitcoin pile. It's a way to get equity exposure to the asset without dealing with custody or cold wallets or any of that.
And let me just play devil's advocate for a second. If I just wanted Bitcoin exposure, I'd go buy a spot ETF or just buy the coin myself. Why take on the execution risk of a whole company? That's where the operating business has to justify its existence, right?
Huh.
They need to prove that the business side can actually generate alpha on top of just holding the Bitcoin.
Exactly. And this brings us right to the second pillar, the asset management business. They manage over $2 billion in assets right now, and their brand in that space is highly specific. They market themselves around meritocracy and what they call unapologetic capitalism.
Right. They are essentially the anti-ESG shop.
They are. And look, regardless of where you personally stand on that political spectrum, we're certainly not taking a side on the politics here. From a purely structural market perspective, it is a brilliant business move because it creates what we call sticky capital.
Break that down for the listener. Why is this anti-ESG capital stickier than regular capital in an index fund?
Well, think about your typical investor in a broad market fund. If the market dips 10%, they might panic and sell. They're strictly there for the return. But Strive's investor base is largely there for the mission. They believe that environmental, social, and governance mandates are actively harming corporate efficiency.
Right.
So they are investing their money in Strive because Strive promises to use its shareholder voting power to vote against those ESG mandates at corporate board meetings.
So the investors aren't just buying a financial return, they're buying a voice.
Precisely. That means even if the fund underperforms the broader market slightly for a quarter, or if things get choppy, those investors are way less likely to redeem their shares. The switching costs are ideological. That creates a highly stable base of management fees for Strive.
Which is their cash flow engine. You have $2 billion generating steady fees, completely regardless of what Bitcoin does on any given Tuesday.
Right, and here is the exact problem. Strive Face Asset Management is an incredibly competitive, lower margin game unless you have massive, massive scale. They needed more cash flow to aggressively fund this Bitcoin treasury strategy. You simply can't just go buy 7,000 Bitcoin on management fees alone when you have $2 billion under management.
Enter Semler Scientific.
Yes.
This is the part that confused so many people initially. Semler makes QuantaFlo, right?
Yes, QuantaFlo.
Yes.
It's a non-invasive test for peripheral artery disease. Basically, it measures blood flow in the legs.
Okay, so we have a Bitcoin-loving ETF manager selling blood flow tests. Connect the dots here. Why this specific medical company?
It comes down to a classic business school concept, the BCG matrix. Semler Scientific is a textbook cash cow. The product, QuantaFlo, has fantastic margins. It's already established in the medical field. It doesn't require a massive amount of new research and development spending to keep it relevant. It just spits out cash quarter after quarter.
So they bought the cow to get the milk.
Exactly. But it goes a layer deeper than just the cash. Semler was already a public company, and crucially, Semler was already executing its own Bitcoin treasury strategy before Strive even bought them.
So they didn't just randomly buy a medical company. They bought a fellow believer in the space.
They consolidated a balance sheet. By acquiring Semler, Strive instantly absorbs Semler's existing Bitcoin holdings. And more importantly, they get permanent access to that steady stream of preventative healthcare revenue. Healthcare is generally recession-resistant. People need heart and blood flow tests whether the economy is booming or crashing.
I see the logic now. You take the steady, boring cash from the medical tests to buy the volatile, high-upside asset, the Bitcoin. It diversifies the revenue streams so the company isn't entirely dependent on the whims of the ETF market.
It effectively turns the healthcare operations into a massive mining rig. Instead of burning electricity and computing power to get Bitcoin, they are burning medical device sales.
That is a fascinating way to look at it. But acquiring a whole company and stacking that much crypto requires serious, serious capital. You can't do this with pocket change. And this leads us to the financial engineering aspect of the bull case, specifically this SATA offering I keep seeing in the filings.
This is the piece that often gets glazed over by retail investors, but it is arguably the most important part of the entire bull thesis. SATA stands for Series A Perpetual Preferred Stock. Strive raised $225 million through this specific instrument.
Let's unpack perpetual preferred stock for a second, because usually when a company needs money, they do one of two things. They either issue normal common shares, which dilutes everyone's ownership, or they take out a massive bank loan, which comes with interest payments and a hard due date. This seems to be something in the middle.
It is exactly in the middle. Preferred stock is technically equity, but it acts a lot like debt because it pays a fixed dividend to the holders. In this specific case, the yield is quite high. We're talking around 12 to 14%.
Wait, 14%? That is a very high cost of capital. Why on earth would they agree to pay that much when traditional interest rates are significantly lower?
Because of control and safety. Think about the alternative. If you take out a bank loan for $200 million to go buy Bitcoin, the bank is going to impose heavy covenants. They will say, look, if the price of Bitcoin drops 30%, you have to pay us back immediately. That's a margin call. And that is exactly how over-leveraged companies go bankrupt in a crypto winter.
Right. The bank liquidates your assets at the absolute bottom of the market.
Exactly. But with perpetual preferreds, there is no maturity date. There is no bank looking at the daily Bitcoin price chart and threatening to pull the plug. Strive has to pay that 14% dividend, yes, but they aren't at risk of a forced liquidation if the asset price swings wildly.
So they are willingly paying a premium, that high yield, essentially as insurance. They are buying the ability to hold through a crypto crash without going bust.
That's the trade-off. It's expensive capital, but it's patient capital. And here is the kicker. They use the proceeds from this SATA offering to retire almost all of their traditional debt. They now have only about $10 million in actual debt remaining on the books.
Which is essentially negligible for a company of this size. So the balance sheet is technically very clean now. No looming debt maturities, just this preferred stock dividend obligation.
Correct. It transforms them from a heavily levered, risky gambler into a financial structure that can theoretically survive a significant market downturn.
Theoretically. And that seems like the perfect segue to the bear case. Because we've painted a pretty rosy picture here so far. Sticky ETF capital, medical cash cows, and clean balance sheets. But this stock is a high beta play.
It is incredibly high beta.
And just for clarity, high beta simply means the stock moves much more aggressively than the underlying market, right?
Yes. If Bitcoin moves up 1%, A high beta proxy stock like Strive might surge up 2 or 3%, but that sword cuts both ways. If Bitcoin drops 1%, Strive might plunge 3 or 4%.
So you are deeply levered to the price action of the coin itself.
You are. And we have seen historically that Strive's stock price is heavily, heavily correlated to Bitcoin holding specific support levels. Specifically, that $67,000 friction point.
That's the danger zone.
It is. When Bitcoin drops below 67,000, the broader market tends to discount Strive significantly. The premium on the stock just evaporates. So if we enter a period where Bitcoin chops sideways at 60,000 for 6 months, Strive's stock is going to hurt proportionately more.
You really need an iron stomach to hold this. And that brings up the yield trap risk we were hinting at. We talked about that 12 to 14% yield on the SATA shares. That's super attractive to income-focused investors.
Yeah.
But if the stock price collapses because Bitcoin drops, that yield doesn't really save you.
Exactly. Total return is what actually matters. If you make 14% in dividends over a year, but you lose 50% on the underlying share price, you are still down 36% on your investment.
Ouch. There is also an execution risk here that I think we need to highlight heavily. We talked about how brilliant the hybrid model is, the asset management plus the medical tech plus the Bitcoin treasury. But from a pure management perspective, isn't that just a lot to juggle?
It is a massive management challenge. You are asking one single leadership team to effectively run 3 completely different businesses. Running an ETF shop requires intense focus on regulatory compliance, marketing, and managing fund flows. Running a medical device company requires a focus on sales teams, healthcare regulations, FDA approvals, and supply chains.
And managing a billion-dollar crypto treasury requires nerves of steel and constant monitoring of the capital markets.
Precisely. The core bear argument is remarkably simple lack of focus. Can they really optimize the medical business while they're so openly obsessed with financial engineering and Bitcoin accumulation? If the management team gets distracted by the crypto side and the similar sales team starts missing their quarterly targets,
The cash cow gets sick.
the cash cow gets sick, the cash flow drops, and suddenly that 14% dividend payment looks a whole lot harder to make.
That's the nightmare scenario. The entire flywheel breaks down.
And remember, management has stated a very public goal of reaching break-even or slight profitability in 2026. That is a tight timeline. They need the similar integration to go smoothly right now. They need the ETFs to keep growing organically. And they need Bitcoin to cooperate.
It's a really delicate balancing act. So for the listener watching this on the sidelines, wondering how to play this over the next 30 days to a year, what are the actual signals to watch?
Well, obviously, crypto price action is the king catalyst.
We're looking at that $69,000 level.
That is the absolute line in the sand. If Bitcoin breaks and holds above 69,000, historical price action suggests Strive will outperform significantly. It acts as a magnet pulling the stock up. If we are below that, expect a lot of painful chop.
What about on the actual business operations side? We need to see if this similar marriage is actually working in practice, not just on a spreadsheet.
We need concrete integration updates. We need to see the receipts. Are the cash flows from the medical side actually moving onto the balance sheet as promised? Investors should be listening very closely to the next earnings call and not just looking for top-line revenue, but for the mechanics of that cash transfer. If management starts talking about delays or unexpected one-time integration costs, that's a flashing red flag.
And speaking of that earnings watch, we're looking for absolute confirmation of that 2026 profitability timeline.
The market runs on narratives in the short term, but it eventually demands hard numbers. If they come out and say, well, actually, break-even is pushed back to 2027, the stock will get heavily punished. The current valuation is completely pricing in successful on-time execution.
I also wanted to touch on the rumor mill for a second. We try to stick to verified facts here, but there is some loud noise right now about AI. And look, in 2025, if you don't say AI at least once in your prospectus, are you even a public company?
It really is the buzzword of the decade. But there is some genuinely interesting, albeit entirely unconfirmed speculation about Strive launching AI-driven EPF products.
What does that actually look like in practice? Personalized portfolios.
Potentially, yes. Imagine an ETF strategy that uses advanced AI to dynamically adjust its holdings based on a user's specific risk profile or real-time market conditions, rather than just tracking a static index. If Strive were to launch something highly innovative like that, it would be a massive catalyst for AUM growth assets under management, completely independent of what Bitcoin is doing.
Right. It would essentially give them a tech valuation multiple on the asset management side, distinct from the crypto side.
It would. It creates a third bullish narrative. But
Yeah.
again, right now it's just a rumor. Investors shouldn't base their thesis on it yet.
And regarding price targets, I know we don't do ratings on the show, but the analysts who cover this niche space, like Maxim Group, have thrown out some interesting psychological numbers,
There's a lot of chatter around that $1.50 mark as a key technical level.
which would be a significant point of friction based on its history.
It's a major psychological hurdle for the market. But remember, analyst targets are just opinions. The market still has to do the actual work of getting the price there.
So let's zoom out and synthesize the big picture here. Strive is essentially a high-risk, extremely high-reward experiment in modern corporate finance. They have a real asset management business, a clean, low-debt balance sheet, and a massive Bitcoin bet.
It is a fascinating test case. They are testing whether a company can simultaneously monetize values via the anti-ESG stance, monetize stability via the medical arm, and then funnel all of that liquidity into what they view as the hardest money on earth.
It's audacious. And honestly, it forces us to rethink what a value stock even is in this environment. And that's a thought I want to leave you with today.
Go.
If Strive actually pulls this off, if they successfully use boring healthcare profits to build a massive, impenetrable Bitcoin fortune, do we start seeing other non-financial companies becoming Bitcoin proxies by accident? Do we see a regional construction company deciding to hold a Bitcoin treasury? Do we see a fast food chain doing it? And what does that do to the traditional definition of a value stock?
That is the trillion-dollar question for the next decade. We are already seeing the corporate treasury standards shifting in real time. For decades, the term risk-free strictly meant U.S. Treasury bonds. But if non-financial companies start viewing Bitcoin as the superior reserve asset, the very definition of a healthy corporate balance sheet changes fundamentally.
Right. Does value investing in 2030 just mean finding out who has the most Bitcoin sitting on the books?
If that happens, Strive will be looked back on as an absolute pioneer. If it fails, it will be taught in business schools as a cautionary tale about a catastrophic lack of corporate focus.
Either way, it's going to be one hell of a show to watch. That's the lowdown for today. Thanks for hanging out with us on the Easy Money Show. See you next time. Don't forget to subscribe. We'll see you in the next deep dive.